If you've been paying any attention to the financial news lately, it's just confusing, right? The economy is supposedly doing great, but maybe you're not feeling it. Tech is absolutely exploding, but jobs feel, well, kind of uncertain. So let's just cut through all that noise. Because what's really going on under the surface tells a massive story about our economic future and honestly about your place in it. Okay, so it all kicks off with this weird puzzle. The Federal Reserve, the Fed, finally did the one thing the market has been begging for. They cut interest rates. Now, usually that's party time, right? Stocks should have gone on the moon. But they didn't. The reaction was kind of meh. So what gives? What is actually happening behind the scenes? That's exactly what we need to figure out. All right, the key to this whole thing is realizing that, believe it or not all rate cuts are created equal. This specific move, analysts are calling it a hawkish rate cut. And I know what you're thinking. That sounds like a complete contradiction. Hawkish means aggressive. So how can a cut be aggressive? Well, it's all about the message the Fed is sending. And that message is exactly why the market kind of shrugged its shoulders.
So this really lays it out perfectly. A dovish cut, that's the good one, the one everybody wants. It's a signal that says, hey, we're just getting started, more help is on the way. But a hawkish cut, which is what we got, is the Fed basically saying, all right, here's one cut, enjoy it, because that might be it for a while. And you can see how that just kills the optimistic vibe, right?
But just as everyone was trying to wrap their head around this hawkish cut, the Fed pulled another move, a much quieter one, almost a hidden one. On the very same day, they also kicked off what you could basically call a stealth money printing program, a little quiet injection of cash right back into the system.
So the official name for this is Reserve Management Purchases, or RMP. And here's the absolute key. This is not the same kind of money printing we've seen before, that big bazooka called quantitative easing, or QE. Think of it this way. QE is like hitting the gas to make the car go faster. RMP is just making sure there's enough oil in the engine so it doesn't seize up. It's a defensive play, about preventing a crisis, not creating a boom. All about stability, not stimulus.
So let's recap. You've got the Fed tapping the brakes with that hawkish cut, but at the same time, they're quietly making sure the system doesn't stall out. These moves seem like they're fighting each other, but they're not. They're actually symptoms of a much bigger, much more powerful trend that's reshaping our entire world. It's called the K-shaped economy. And this weird balancing act from the Fed, it's actually pouring fuel on that fire.
So, what on earth is a K-shaped economy? Well, it's what happens after a downturn when the economy doesn't bounce back for everyone. Instead, it splits, dramatically. One part shoots straight up. That's the top arm of the letter K. At the same time, another part flatlines or even drops. That's the bottom arm. And this gives you a super simple but really powerful picture of who's on which path. That top arm of the K? That's for the asset owners, people whose money is in stocks, real estate, you name it. Their wealth is climbing. But the bottom arm? That's for the wage earners, which is most people, whose financial security is either going nowhere or actually getting worse, especially with inflation.
And look, this isn't just some abstract theory. You can see it clear as day in the data. This chart is the K-shape in action. On one hand, you have the S&P 500. Think of it as a scoreboard for asset owners. It's going up. On the other hand, you have consumer confidence, which shows how most people are actually feeling about their finances, and it's going down. It's literally two different economies happening at the exact same time.
And if you're sitting there wondering, well, why is this happening? This chart is pretty much the entire story. A mind-blowing 87% of the entire stock market is owned by just the wealthiest 10% of Americans. Meanwhile, the entire bottom half of the country owns just over 1%. So, when the Fed makes moves that pump up asset prices, you can see exactly who reaps almost all of the rewards.
Okay, so this economic split isn't totally new, but right now it's being put on steroids by the single biggest technological shift of our lives, artificial intelligence. And make no mistake, AI is about to completely rewrite the rules for how you build wealth and find opportunity.
I mean, wow, that is a heavy statement. But it gets right to the heart of the anxiety that so many of us are feeling. The fear here isn't just about whether AI will take our jobs. It's something way, way deeper. It's the terrifying possibility that AI could make human labor, in general, just less valuable.
Let's just zoom out for a second. For pretty much all of human history, moving up in the world, economically speaking, was almost impossible. You were born into your station. The information age, our age, has been a golden window for that kind of mobility.
But the argument here is that we are now entering a critical 10-year window, a final great reshuffling. This might be the last real shot for a lot of people to climb that ladder before the AI age locks in the economic structures, maybe for good.
So faced with that, how do you make sure you end up on the right side of this reshuffle? The path forward seems to be splitting into two main lanes. The first is to own the capital, to literally have a piece of the companies and the assets that are building this future. And the second, become an absolute master of the AI tools. Use them to make yourself so good, so efficient, so valuable in your field that you are impossible to replace.
And this is where we bring it all back to crypto. Because that whole idea of owning assets is going through its own massive revolution. It's called tokenization, and it's basically the bridge that's being built right now between the old financial world and the new digital one. Now listen, this is not just some crypto person on the internet saying this. This quote is from a former chairman of the SEC. When the actual top regulators are saying that tokenization is the future, you know a fundamental shift is happening. This is not a fringe idea anymore. This is becoming Wall Street and Washington consensus.
So why is everybody from Wall Street to DC suddenly getting so excited about this? Well, because tokenization, putting assets on a blockchain, actually solves huge real-world problems. It gives us unbelievable transparency, it could lead to instant financial settlements, and it makes the entire system safer and way more efficient.
And the real key here, the trend you need to watch, is the tokenization of real-world assets, or RWA. This is the big one. This means taking things we all understand, stocks, bonds, real estate, art, and turning them into digital tokens on a blockchain. This is the moment the trillion-dollar traditional markets start pouring into the digital world.
And we can already see where this is all heading. This chart shows us that right now, something like 60% of all tokenized real-world assets are sitting on Ethereum. It is becoming the clear dominant platform for this new financial plumbing. Wall Street is placing its bets, and for now, it's backing the established leader.
And this massive wave of real-world value and institutional money is what's behind this idea called the supercycle. The theory is pretty simple. As all this institutional capital starts flooding in, it could finally break crypto's old, predictable 4-year boom and bust cycle. We might be moving into a new phase of more sustained growth, driven not by hype, but by actual real-world use.
And just to give you a sense of the insane scale we're talking about, look at this number. A single big bank might manage, say, $3.5 trillion. If they decide to put just 1%, just a tiny slice of that into crypto, that's a $35 billion injection. To put that in perspective, that's more than all the money that has flowed into all the new Bitcoin ETFs combined. Now imagine dozens of banks doing that. You start to see the tidal wave that's forming.
Which brings everything back to the single most important question. We are moving into a new world, one that's going to be run by AI and built on digital assets. The K-shaped lines are being drawn sharper than ever before. And in this new world, you simply cannot afford to be just a passive user of these technologies. So the question you really have to ask yourself is this: are you going to be an owner or just a user?